Chapter 2, now we're going to look at the value chain and the income statement. Now, managerial accounting is all about what we call costs. And we have different names depending on what we're doing for the same information. So, just like debits and credits are part of the language of financial accounting, this chapter is all about language of managerial accounting. And we go over more of this in part 2. The category of the cost determines how you use it when analyzing costs for managerial decisions. So please make sure you understand the meaning so you'll be successful understanding the rest of the chapters. Now these are the terms we're going to be going through. We're going to look at the value chain, total types of businesses, value chains, direct versus indirect, total cost, product versus period, and then the new categories for inventory when we manufacture. Now, types of business. When we did financial accounting, we mostly looked at service companies, which generally have no inventory or cost of goods sold. And we looked at merchandising businesses, which have inventory and have cost of goods sold. But in managerial accounting, we're going to be looking at manufacturing companies. Manufacturing companies take material, add labor, and other costs to convert it to finished products. Example would be a car. Now, when you are making something, you're going to end up with 3 categories in your inventory: raw materials, work in process, and finished goods. This, again, is our focus. Now, the only difference relates to how inventory is shown in the current assets section. Service companies normally have no inventory. Merchandise companies show only inventory because they buy and sell. They don't do anything, convert it. Manufacturing companies have raw materials, work in process, and finished goods, and these are all part of what we call inventory. Now, the value chain. We have first we research and develop the product, we design it, then we produce it, then we have to market it, then we have to distribute it, and then we have to have customer service. So these are all the costs we look at when we try to figure out are we making any money. Now, direct costs, costs that can be traced to the cost objective, readily associate the cost with the object. If you are making a dress, it would be the fabrics, the buttons, and the labor. Indirect costs, now these, when we talk about costs here for direct and indirect, we're talking about manufacturing costs. Indirect costs relate to the product, but can't be traced to a specific item. So it's allocated over several cost objectives. An example would be a supervisor's salary would be a good one. Now, what we do with direct and indirect costs, we have to categorize them because direct costs we can apply directly, collect directly to the cost objective, but indirect costs, costs that we know are part of the cost, like the depreciation on the building, but it's not tied to one unit, those we have to allocate. Now, examples for classifying direct versus indirect costs. We are a dress department inside a large department store. What would be the direct or indirect cost for the department? The dress department sales clerk's wages, direct. Those direct would be directly associated with selling the goods. Cost of the clothing, direct. Cost of the hangers used to display the clothing, that would be indirect because if every time they bought something they got a hanger, you could call it direct. But if the hangers are used for more than one thing, they would have to be indirect. Electricity would be indirect. Advertising would be indirect. Clothing buyers' salaries. These would be for all the departments. That means it'd have to be indirect. Depreciation of the building, indirect. Cost of bags used to package customer purchases, indirect. Store manager salary, indirect. Cost of security would be indirect. And the dress department manager salary would be direct. So that kind of gives you an idea of how we categorize costs. Now, we consider all costs incurred across the value chain, and that's called total cost, and we need to know if we're making money because the price has to cover all the costs, plus we have to make a profit or we won't be profitable. Now, under GAAP, we categorize manufacturing costs into categories. We have what we call product costs. These are incurred by the manufacturer to produce their product. This is all the costs associated with making the product. So all of this is kept in inventory and treated as an asset until it's sold. Period costs do not get treated as inventory. They are immediately expensed in the period that they occur. Examples would be selling, operating, administrative expenses. Now, again, the manufacturer's total cost we break down between two categories. We have product costs, which are treated as inventory until we sell, and we have period costs that are expensed as we go. Now, product cost is made up of direct material, direct labor, and what we call overhead, which are all indirect costs associated with making the product. And these are going to be allocated. We talk about that in Chapter 3. Now, I love this presentation because what it says is the total cost in 2020. We have product costs, which are going to go to inventory, and if they're sold in 2020, they're going to go on the income statement as cost of goods sold. If they're not sold, they're going to go to inventory, they're going to be on the balance sheet, and in the next year they'll become cost of goods sold when they're sold. The period costs are all going to be part of operating expenses in 2020. Now, calculating cost of goods sold for a merchandising company under perpetual inventory system. You always look for the beginning inventory. You look for any purchases and freight in. Now, not delivery expenses or freight out. Those are selling expenses or period costs. Less ending inventory will give you cost of goods sold. So first, what we want to do in this example is we want to determine the cost of goods sold. So we find the beginning inventory, we look at the purchases, we take out the ending inventory, and it tells us our cost of goods sold for the period is $38,900. Now we can do the income statement. We start with the revenue, subtract the cost of goods sold to get the gross profit, and then we subtract our operating expenses, telling us we have profit of $4,400. Now, what happens if we decide instead, you know what, I think it'd be better if we made these ourselves. What you're going to do is you're going to have to expand your accounting for inventory, and you're going to have 4 new accounts. You're going to have an account called raw materials. These are materials that are used in the manufacturing process and are issued to work in process if direct and to overhead if indirect when they're needed. Work in process. This is where we collect all the costs associated with making the product, including direct materials, direct labor, and overhead. Overhead. This is where we collect all the indirect costs, including labor, materials, and other costs associated with making the product, but we can't identify it directly to the product. And we're going to allocate these to work in process. And then we have finished goods. When items are completed and ready for sale, they are transferred out of work in process into this account. When a sale is made, the cost is transferred from finished goods to cost of goods sold. So I can say without a doubt, while you're taking managerial accounting, you cannot sell anything out of, the only account you can transfer it out of is finished goods. Any inventory is going to equal raw materials plus work in process plus finished goods. So what happens if instead we're looking at, again, how do we figure out cost of goods sold if we are a manufacturer? Now it gets a little more complicated. We start with our raw materials, we start with our beginning inventory, we add our purchases, we subtract ending inventory, and that tells us how many materials was issued. It's going to go to work in process, assuming it all is direct. We'll start with our beginning work in process plus direct materials used plus direct labor plus overhead allocated to get total cost of goods manufactured. Minus ending inventory gives us cost of goods manufactured. That then transfers to finished goods. We start with the beginning inventory, cost of goods manufactured. Then we come up with cost of goods available for sale minus ending finished goods. And then we get how much goes to cost of goods sold. So now let's look at a problem. Here is our problem. This is all the detail. Now, the first thing I would do if I were working a problem like this is I try to figure out if they want me to determine, in this case, cost of materials used, cost of goods manufactured, cost of goods sold. I need to first classify my costs into what would go to raw materials, what would go to WIP, what would go to finished goods, and what would be indirect costs and operating costs. So I would go through them. Beginning raw materials, I know that's going to be part of my raw materials. Beginning finished goods, part of my finished goods. Beginning WIP, part of my WIP. Direct labor, going to go to WIP. Direct materials purchased is going to be raw materials. Utility is going to be indirect because it's for the plant. Delivery expense, operating expense. Sales salaries, operating expense. Janitorial services, indirect equals overhead. Sales revenue would just be sales. Rent on the manufacturing plant, indirect costs equal overhead. Customer service hotline would be operating costs. Now that we've categorized these, now we can go through and figure out our cost of goods sold. Now, we start with raw materials. They said we had beginning of 14, we had purchases of 30, and we subtract the ending inventory, and that tells us how much of the direct materials were used. Now we go to work in process. We start with beginning work in process. We add our direct materials used, we add our direct labor, and then we need to figure out how much overhead would have been allocated. Assume we allocate it all. And that's going to give us 15,850. We're going to add all that up, and that's going to give us our total manufacturing costs less ending inventory, and we know that's cost of goods manufactured. Now we go to finished goods. We again always start with the beginning, look for a beginning, add the cost of goods manufactured, subtract out the cost. Now we have the cost of goods available for sale. We're going to subtract out ending inventory, and now we have our cost of goods sold. Now we can do an income statement. We're going to start with our sales revenue, subtract our cost of goods sold to get our gross profit, subtract our operating expenses, and we get our net income. And then what's our balance and ending inventory? Well, it would be our ending raw materials, ending work in process, and ending finished goods. And that concludes part 1 of chapter 2.